Hey everyone, Logan Hertz here with Hazeltine. We're really excited today to have Don Graves on the program with us today. Don Graves is the president and founder of the Housing Wealth Institute. He's an author and instructor of retirement income at the American College of Financial Services. He's considered one of the nation's leading educators on incorporating housing wealth into retirement income planning. I consider him the leading educator. He's been quoted in Forbes magazine, featured on PBS sponsored shows, recognized as one of American College's top 11 retirement income leaders. You can go on and on and on. He's got a unique perspective that very few share as a retirement income certified professional, long-term care specialist, CSA certified senior advisor. He understands the powerful principles and strategies regarding retirement income planning, its design, intent, risks, and limitations. And his main focus is on reverse mortgages and how they intersect with retirement income planning. So, Don, thank you so much for joining us. Great to have you on the program today.
Thank you, Logan. Fantastic to be here.
Don is not only the best educator in reverse mortgages, he's also the best dressed educator in reverse mortgages. So we appreciate that. So having come from a consulting background, I certainly appreciate the importance of that level of professionalism. So Don, let's just start at the beginning. What's a reverse mortgage? How does it work?
What is a reverse mortgage? I typically say it's a good way to get stabbed at a barbecue if you're not careful. You ever mention a reverse mortgage at last event you went to? What happened? Three people went under the table, three people left.
It's a scam, Don. It's a scam.
Aunt Janie made a shank out of a plastic knife and fork and came after you. It's dangerous.
Right. I know my grandma, they kicked her out of her house and blah, blah, blah. It's just,
It's dangerous to mention it in mixed company. But for the viewers and listeners, let me tell you what a reverse mortgage is. I hope this sticks with you. It's four letters, IJAM. IJAM. What is that? It's just a mortgage. It's just a mortgage. It started in 1961 in the United States, became under the auspices of the Federal Housing Administration of the U.S. government in 1988. So it's not new, it's not dangerous, it's not spooky. It's one of a three-legged stool that the government supports to undergird retirement. Social Security, 1935, Medicare, 1965, and the Home Equity Conversion Mortgage, HECM, 1988. Also pronounced the HECM. Reverse mortgage is a nickname. So what is it, Logan? A reverse mortgage is a federally insured loan, a home equity loan for those age 62 or better, that allows them to convert a portion of their home's value and turn that into tax-free dollars without giving up ownership of the home, without coming off title, and without having to make mandatory monthly mortgage payments. That is a reverse mortgage.
So how does it fit into, you mentioned retirement income planning, and that's so important because I think when you get to retirement, it's not about the size of your nest egg. It's more about how much safe, reliable, passive income can you generate. So maybe start by telling us a little bit of how a reverse mortgage works, and then we can talk about how it fits into retirement income planning. So how does it work, Don?
25 years ago, I was sitting at my desk. I was the CEO of Habitat for Humanity here in Greater Philadelphia. My sister called me and she said, "Little brother, I want to tell you about a business opportunity I have." My sister's 12 years older than me. And so she says, she describes this deal. And Logan, I thought, oh, that's it. She's going to prison. Out of all the things she's ever described, now she's taking old people's houses. And I said, don't tell me about that. I don't know. I don't want to. And I dismissed it for a year. A year later, I circled back. I called 5 housing counseling agencies in Philadelphia area, got breakfast with 3 of them. I said, what's the gotcha? What's the catch? What's the aha? What's the fine print? I went to the U.S. government had an office and home ownership center in Philadelphia. I went with them. I talked with Fannie Mae. I talked with AARP. And at the end of all that research, I said, wow, this is a very beneficial tool for the right person. So I was a skeptic. I was a bold skeptic about it. And then I began to see what it could do. And one of the questions I ask people is this. If your home could be used to increase your cash flow in retirement, would you want to see how it works? That's a very simple question. Here's another question. I say, Mr. and Mrs. Jones, I see that you're already making a monthly loan payment. Somewhere up to 70% of baby boomers are coming into retirement, Logan, with a mortgage payment on their property. So I say to them, I'm curious, if you had a choice, would you rather that payment be mandatory or voluntary? What would you choose? And they look at me and say, duh, voluntary, of course. I ask them why. They say things like freedom, flexibility, control, a hedge against uncertainty, spend less, save more, sleep better, any of those things. And then finally, I say to them, so if there's a way that we could turn your mandatory monthly mortgage payment into a voluntary one, would you want to see how it works? Now, all of those examples I gave are all describing what a reverse mortgage is designed to do and how it incorporates into a retirement planning scenario. The TV commercials, you're not buying a new car. You're not buying a cabin in the woods. You can, but really what you're doing is that reverse mortgages are about retirement. It's one thing to scale the mountain, to get up there, take your stance, plant your flag, count your money. It's another thing entirely to come down the other side. That's where the danger lies. And so I say, Mr. and Mrs. Flintstone, are you 100% certain that you're going to have a great retirement? Do you have some doubts? Most people have doubts. I said, if there was a proven resource, listen, folks, if you're watching me, you may want to grab a pen or paper because I'm going to give you some nuggets, some acronyms, some things that I think will be beneficial. And Logan, thank you again for having me on. And I said, if there was a resource, a proven resource overseen by our federal government that allowed you to increase your cash flow, reduce the risks you incur in retirement, preserve the assets you have, improve the liquidity, your access to dollars when you need it, or even add new savings back to your retirement. If there's a proven resource that allowed you to do one of those 5 things, would you be open to seeing how it works? That, Logan, is what a reverse mortgage is designed to do and how it's incorporated into a retirement income plan.
Great. So those sounded like great benefits to me. So again, to follow up on your question, would you want to see how it works? Yes, Don, I'd like to see how it works. So can you kind of just briefly explain how does it work? How are we able to get these great benefits? When I've heard this is a scam and my grandma got kicked out of her house because of a reverse mortgage.
And let me, before I talk about how it works, let's address that. Let's address the elephant in the room, and which is, hey, wait a minute. I knew a person who had a reverse mortgage, who had an aunt, had a cousin, had a grandmother. She got a reverse mortgage. She grew a beard. Her dog died, and then she died. And I was like, whoa, that's a lot of death. And so what's going on with that? And I said, well, I said, there are 4 requirements when a person gets a reverse mortgage. These may be spooky to some, but they're 4 requirements. Matter of fact, when you get any loan or mortgage, there are requirements. But the reverse mortgage is going to make money available to you age 62 or better based on 3 criteria. I'm holding my hand up like a triangle. This is not the Illuminati. It's not Jay-Z. This is a triangle here. Don't get scared. Don't write Logan. So the 3 criteria are, number 1, the age of the youngest borrower, the value of your home, and the long-term interest rate. So those 3 things, how do you determine how much we get? Mr. and Mrs. Flintstone, age of the youngest borrower, that's Wilma, value of the home, bedrock, $600,000, and the long-term expected interest rate. So those things go out into a formula federal government has, and it comes back and spits out a number. So the number in the middle of the triangle here, let's call it $250,000, $250,000. If there's an existing mortgage on the property, let me grab a piece of paper here. Logan, I'm so used to it. You don't mind if I draw, do you? Please say it.
Draw diagrams, yeah. As long as there's no drawings of people, just block diagrams are fine. I've spent many time in the consulting world, and whiteboards are great.
So here, folks, listen. Mr. and Mrs. Flintstone, the amount of money that's made available to you is based on 3 things: age of the youngest borrower, value of the home, and the long-term interest rate. So for them, $250,000 is made available to them. Now, if they have a mortgage on their property, I'm going to put that underneath the bottom. See that 200,000? I'm going to subtract that. This is very important. And then finally, what's left over when I subtract those things? What's left over is $50,000. And that's called a GLOC, a growing line of credit. Now, let me unpack that along with the misconceptions and the dangers. So, when someone says, I'm interested in a reverse mortgage, I don't know that. Listen, I've been doing this 24 years. I've had 16,000 consumer facing conversations, and about 3,000 people went forward to become my clients. And all that tells us is that as good as the program is for many, it's not always the right thing to do. So, Mr. and Mrs. Flintstone, I don't know if it's right for you or not. Today, I'd like to ask you a few thought-provoking questions, explain the program, and answer the questions you may have. And then together we can determine what the most appropriate next steps should be. That's how I start every one of my conversations. So Fred and Wilma say, I said, what's going on? They say, well, this mortgage we got it at 55, and it's $2,000 a month principal and interest. And now that we're retired, boy, that's a lot. I said, okay. I'm curious, if you had a choice, would you rather the payment be mandatory or voluntary? They say, duh, voluntary. So if I can show you how to turn your mandatory payment to a voluntary one, would you want to see how it works? And we show them something like this. So I say, a reverse mortgage is going to make money available to you based off of your age, value of the home, interest rate. It makes $250,000. We're going to pay off your existing mortgage of $200,000. Logan, let me ask you a question. When we pay off Fred and Wilma Flintstone's $200,000, what does that do for them?
It frees up $2,000 a month that they were paying on the mortgage payment, right? At least as to start, right?
Absolutely. Absolutely.
So they now have that extra cash flow available. Additionally, they now have a $50,000 growing line of credit that they can access. And we say line of credit, there are no repayment terms, right? It is a non-recourse loan. That's really important to understand. So they don't have to make payments back as long as they're in that home and they're alive if they don't want to, right? So it's a line of credit they can access, but no one's going to come after them if they decide, we're not going to pay it back, right?
That's right. So Fred and Wilma now have freed up $2,000, what I want to emphasize, after-tax dollars. Let's say Fred had an $800,000 investment, and every month they're taking $4,000 a month out of that to live. Well, that's taxable money. So they've got to come up with $2,000 a month to pay their mortgage payment.
And it can affect Social Security taxation too, right?
Absolutely.
This would not count as income, right? Because it's not technically income, it's actually a loan, although it's effectively tax-free income, but it would not affect Social Security taxation, right?
Well,
so
in this particular example, I would say, Fred and Wilma, you have to take out $2,000 a month from your retirement savings of the $4,000 you get. And I said, but it takes you $2,500 a month to net $2,000. I said, when we get rid of that monthly mortgage payment, we're actually going to retain $2,500 in your account, $30,000 a year. What does that mean? That means your retirement savings are going to last 10, 15 years longer. Not only that, because you're no longer taking out $30,000 a year, your provisional income goes down. So we're going to reduce your provisional income by $30,000. So your taxes are going to be lower. Not only that, maybe you were on the bubble and your Social Security was in danger of being taxed at 50 to 80%. Maybe you were going to get the IRMA taxation that will reduce it. But simply eliminating a mandatory monthly mortgage payment could have all of these benefits. In addition to
And I want to cut you off, Don, because there are a couple of themes this is bringing up in retirement. First of all, to your point, people look at an $800,000 nest egg and they say, I have $800,000. Well, not really. Not really. There are a lot of caveats to that. Even if it's in, let's say, a retirement account, unless it's a Roth, you're going to pay taxes on that, right? So you really don't have $800,000. Plus, you're taking on market risk, right? what we're doing here is what's so important in retirement. I think people who are nearing retirement appreciate this more and more and more. It's not about the size of your nest egg. It's about how much safe, reliable, passive income can you generate. And we have to account for things like taxes, right? This is tax free. When you draw money from your reverse mortgage, it is not a taxable event. That's really important to understand, because I think a lot of other vehicles people think of as being tax advantaged may not be. And taxes are one of those things that people maybe don't consider enough unless they're already a high net worth person and they're thinking that way. So, yeah, I think what you point out is really important. It's actually more than, in this example, a $2,000 a month benefit to you. It's really more like a $2,500 a month benefit because you're not paying taxes on that. And again, it's all about income. It's not about the size of your nest egg, right?
Mm-hmm.
So, yeah, had to jump in with that. Thank you, Don.
Well, thank you, Logan. That's something that so few people, and listen, folks, um, you won't get this type of dialogue in the 60-second television commercial. I'm not mad at the commercial. I'm glad it's bringing exposure to it. But this is not about a commercial. And this is about a retirement income plan. You have the average baby boomer has 4 buckets of wealth they can draw from, 4 buckets of wealth. The first, now some people say, I don't have all 4 buckets. Most of you do. The first bucket is income and retirement. Income bucket, that's Social Security, pension, maybe still employment. And that bucket has one of these on. Hey, can you see that? This goes
Oh,
on
yeah.
this
Yep.
goes on
Yep.
the outside of a house, and you put a water hose. What do you call this, by the way?
A faucet, I guess.
No, no. See, it bothers me when people say that. Hey, folks, this is a spigot.
I'm a
I'm
city dweller, so I don't know
from
these things.
Kentucky. Faucets are inside the house. This is a spigot. Well, anyway, that's going to go on the outside of your first bucket, your income bucket. Number 2, you've got your investment bucket. So, I'm sorry, IRAs, 401ks, 403bs, Hippo, spiders, Bitcoins, second house, a business you're going to sell, something is in that bucket. And you hook up here. Your third is your insurance bucket. That includes fixed and variable annuities, whole and term life insurance, disability insurance, long-term care insurance. And there you can hook up a spigot here. Now, that, as Logan said earlier, you've got to make sure that everything in there is going to last as long as you do and maintain its purchasing power, with all the things that will erode against that bucket: volatility, future tax rates, inflation, all of that. But here, 87% of those who will watch this, you have a fourth bucket. That's called your housing wealth bucket. You're sitting on a housing wealth bucket, like the Flintstones here, like the Flintstones, that you can turn that into something. And now we're going to put a faucet, not on the outside of the bucket, but on the inside, so your neighbors can't get to it. Now, when you turn this on, Logan, instead of water coming out, money comes out. And here's what happens. 3 things all of us are going to run into in retirement. We're going to run into emergencies. Things are just going to happen. There are going to be expenses. How many living in California, Florida, Louisiana, South Carolina discovered your homeowner's insurance went up? Sometimes the whole company is pulled out of the state. So expenses are going to incur. And then enjoyment, things I want to do, things I always wanted to do. I have those 3. Now, when you have emergencies, expenses, or enjoyment, you've got to pull that money from somewhere. So one of these is going to be turned on. It's going to come from your income. It's going to come from your investments. It's going to come from your insurances, or it can come from your housing wealth. That's what a reverse mortgage is designed to do, to give you another spigot. So that it's not a standalone. I always wanted to buy a Corvette. I'm going to go down to the casino and spend it all. No, no, no. Now you got a fourth bucket, and you use everything in conjunction to make sure they all last longer and maintain the purchasing power so that you have money when you need it.
Yeah.
That's a
So,
very important concept.
yeah. So let me summarize a little bit how a reverse mortgage works. And you're the expert, Don, so correct me if I'm wrong.
Okay.
But you call it housing wealth. One of the big assets that people have in retirement that they're typically not utilizing at all is the equity they've built up in their house. What a reverse mortgage allows you to do is turn that equity in your house into a source of income. It could be just a growing line of credit that you can access and not have to repay, right? So that line of credit grows, okay? Or you can turn it into basically an annuity, an income stream where you're collecting income based on the value of your house. And importantly, everything is guaranteed here, meaning that no matter, we say it's a growing line of credit. The growth in that line of credit is guaranteed no matter what happens to the value of your house. This is so important for people to understand because, again, money you have in investments is at risk. There is risk involved there. There can be market crashes, okay? Your house could crash in value. I hope it doesn't happen. But the beautiful thing about a reverse mortgage is now you are insulated from that risk. If we have a 2008 style housing crash, your line of credit keeps growing regardless. There are guarantees associated with this program, right? So I wonder if you could talk a little bit about the guarantees, because again, safe, reliable, passive income. You can't get that from investments because there are no guarantees. Here we have guarantees. So can you explain those guarantees, how it's a non-recourse loan and the growth in the line of credit is guaranteed no matter what happens in the market?
All right. So you mentioned 4 or 5 things. Let's unpack them one at a time. A reverse mortgage is a federally insured loan for those age 62 or better that allow, now only one spouse has to be age 62 in most states. The other one only has to be age 18. And so it allows you to convert a portion of your home's value, turn it into tax-free dollars. You don't give up ownership, come off title, and you're not required to make any monthly mortgage principal and interest payments. The amount of money you get is based off of the triangle. Age of the youngest borrower, value of the home, long-term interest rate gives you a certain amount of money in the middle of the triangle. From that, the Flintstones, if you weren't here, we pay off any existing mortgages, and what's left is a growing line of credit. So the line of credit on a reverse mortgage is non-cancelable, which, like traditional home equity lines of credit, they can be canceled. A reverse mortgage cannot be canceled as long as you're meeting the requirements of the program. Now, that's question number 1. Don, what are the requirements of the program? Is this where the spooky part comes in? I said, this part is spooky. You may want to write this down. See, what happens is, again, you went over to your cousin Tracy's house for the barbecue on Labor Day. And Uncle Jumba came out of Tracy's spare bedroom, and everybody said, Uncle Jumba, what are you doing in there? He says, oh, listen to what he said. He says, I got a reverse mortgage, and I lost my house. And everybody at the barbecue, Logan turned and said, I knew it, and I knew it. And what happened? What happened? Tuesday, someone was at the beauty salon telling the story. Wednesday at the barbershop. Thursday at Rotary. Sunday, they went early, got the deacons at church, said, we need to make an announcement at church. And before you knew it, everybody in the little town knew someone who had an uncle, got a reverse mortgage and lost his house. Then they come back to me.
And I just want to point out, Don, everyone they're getting this information from is, of course, a fully qualified expert on reverse mortgages. We know that, obviously.
It's a juicy story. And then here I'm walking downtown, and a crowd of people accost me, and they said, there he is. There's the evildoer. And they said, Uncle Junebug got a reverse mortgage, and he lost his house. What do you say about that? I said, it's true. It's true. He did get a reverse mortgage, and he did lose his house. But then, then the chatter started. I said, wait a minute. Now, he told the truth. He didn't tell the whole truth, because there are 4 things you have to do when you get a reverse mortgage. I'll put them up to the camera here. Number 1, you have to live in the property. If it's husband and wife, you can kick him out, but one person has to live in the property. Number 2, take care of the property. Number 3, keep homeowners insurance in force on the property. And number 4, pay your property-related taxes. That's not spooky at all. We do that all the time. Now, of these 4 folks on the camera, when Uncle Junebug came out of Cousin Tracy's spare bedroom and says, I got a reverse mortgage and I lost my house, which of these do you think he didn't tell you that he didn't do? That's right. He hadn't paid his property taxes in 4 years. I don't know where you can live in the United States of America, have a home, and not pay your property taxes and not face consequences. Tax lien sale, sheriff sale, right? Nowhere. So his losing the house, though, had nothing to do with the reverse mortgage. It made a good story, but it didn't have anything to do with the reverse mortgage. So that's a common myth that, I can lose my house. Yeah, but it's not going to be because of us. It's go. Um, that's the deal where the bank loans you the money. When you die, they take the house. Nope. IJAM, it's just a mortgage. Well, Don, what happens when mama dies? Mama, or the Flintstones, we're talking about the Flintstones. Flintstones have a $600,000 home. And they bought it in Bedrock for $100,000. Most people on this call, if you had a home or know someone who does, their home is worth more than what they paid for. So 20 years down the road, typical home will double in value every 20 years. It's happened since about the Civil War. So Fred and Wilma, if they're still alive, will have a house that's $1.2 million. That's number one. Your house is growing. Number two, you took some money out of the reverse mortgage. I don't know how much you're going to take ultimately, but you took money, and that money is going to accrue interest over time, unless you decide to make a monthly payment. You don't have to, but it accrues interest. That means you're going to owe me more money than you did when it started. So now down the road, Fred and Wilma took out some money. They went to the casino, spent the rest. And now down the road, they've got a home that's $1.2 million and they owe me $700,000. Let's say they lived a long time. I'm just making up numbers, folks. So how much is their house worth, Logan? 1.2 million. How much do they owe me? 700,000. And they die. They die. The children come in. I think it was Bam Bam. They had more children. The children come in. What typically happens? They sell the home for 1.2 million. They pay back, like any mortgage, you pay off the outstanding mortgage of 700,000, and there's $500,000 left over. What happens to that? That gets divided up with the heirs, the estate, whatever the desires of the client are. But 100% of all remaining equity passes on with the heirs or the estate. Now, once we clear that misconception, no, it's not the loan where the bank loans you the deal, bank loans you the money, and at the end they take the house. Bank doesn't own the house, they don't want the house. 100% of remaining equity goes to you. But wait a minute, Don, wait a minute. What happens if things got real bad in Bedrock and mom and dad owe you $700,000, but their house is still worth $600,000 20 years later? So they have a $600,000 house and a $700,000 mortgage balance. What happens? Because all reverse mortgages are non-recourse loans. Write that down, folks. Non recourse loans. That means the only recourse the lender has to satisfy the outstanding loan obligation are the net proceeds from the sale of the home. Well, Don, the home's only worth $600,000, but we owe you $7. That's correct. So the lender gets $600,000 and accepts it as payment in full, because this is under the federal government. The Federal Housing Administration covers whatever the difference is. There's no deficiency judgment taken against the heirs, the estate, nor the assets can be used for repayment of the note. That's what happens at the end of the loan. 100% passes on to the children, and if there's nothing left to pass on, the children are not on the hook. So those are some of the common misconceptions. So we talked about the 4 requirements: live in the property, take care of it, pay your taxes and insurance. We talked about, do I give up ownership of the home? No. Can I be kicked out of the home? We said no. Does the bank own the home? No. What about this line of credit? We talked about non-recourse as a guarantee that you'll never be required to repay more than the loan is worth. If you've got a line of credit and you're maintaining the
More than
thing.
the house is worth, I think is what you meant to say.
I'm sorry, excuse me. Thank you. If you have a line of credit, that's going to be growing. That's growing for you, regardless of the home's underlying value. So your home could go this way, but your line of credit is going to be growing.
Yeah,
Now,
let's talk about that a little bit. Because again, I like guarantees and I like guaranteed growth. Again, think about it. Go to your financial advisor and say, I want to put money in an investment, but I want a guaranteed return on my investment, right? What return can you guarantee me? Well, the answer is probably going to be nothing. Negative 100% could happen, right? Whereas here, we have a guaranteed growth rate in the line of credit. That's so important to understand, right? And Don, one of the things we talked about off camera that I'd like you to go into is, first of all, explain how powerful that is, this guaranteed growth rate, okay? And why, with Monte Carlo simulations and other analysis that have been done, what they have found is that the best time to take out a reverse mortgage is actually as soon as you are eligible, because the growth in the value of your home is probably not going to keep up with the guaranteed growth rate in that line of credit. That's really powerful. Can you explain that a little more?
So I want to go back to this word guaranteed. And so the line of credit growth rate is not guaranteed. Let me explain this to you. This is how we determine how much the line of credit grows. It's three factors. Let me put it up. Every month it adjusts. The 1-year treasury bill is 5.5. That's going to adjust every month. The lender's margin typically is around 3.0%, and HUD adds 0.5. So these last two, the 3 and the 0.5, those are fixed. Once you get the loan, that doesn't change. The 1-year treasury bill is going to go up or down. So someone says, Don, is it guaranteed to grow? I said, conceivably, the 1-year treasury bill could go to 0, and then it'd be growing at 3.5%. What if a 1-year treasury went to negative 3.5%? Then your line of credit's not growing. Take all the money out, put it under your mattress. So have we ever seen the 1-year treasury at negative 3.5%? No. Do I think it will happen? No. So I don't like to use the word guaranteed, because there could be some freak anomaly that we've never seen. And they say, oh, Logan, Don said it was guaranteed. I'm saying it's been growing as long as the program has been in effect. But if there comes a time that the government is paying us for our money, because it's a negative interest rate, it had to be negative 3.5 in here. So yes, for all intents and purposes, it is a growing line of credit. Now, why is that powerful? Listen, here's the question, folks. If someone comes up to you and asks you this question, Mr. and Mrs. Jetson, George and Judy, I think, was it Judy? Logan, you're too young to remember Jetson.
No, sorry.
Anyway, Edith and Archie Bunker. He said, if your home could be turned into a growing reserve that was currently growing at 7 or 8%, couldn't be frozen, capped, canceled, or reduced, and could possibly surpass $1 million in a reserve, and you're still living in it, would you want to see how it works? Edith and Archie would absolutely, yeah, they're going to say one of three things. Yes, no, what you're talking about, Willis, which was a sitcom when I was growing up. So absolutely. Who wouldn't want to know? Let me rub my eye here. If there was such a thing that I can turn my $600,000 home into a $200,000 or $300,000 growing line of credit, growing at 8 or 9 today, what is that? That's 5.53. That's 9% today, Logan. Adding these three numbers up is 9%. That's right now here today.
9%, folks. 9% rate of growth.
Now, someone says, well, if this is true, not if it's true, it is true. It's been true since 1988. The line of credit on reverse mortgage is a growing line of credit, a GLOC. That spells Glock. No, not a police-issued handgun, but a growing line of credit. It is true. So the financial thought leaders, Dr. Wade Pfau, Harold Ivinsky, Google these names, they would say, what's the optimal time to open up a reverse mortgage line of credit if this is true? And they have concluded the optimal time is at the onset of retirement. Why? Well, that's like me. My daughter's 29, and she says, Dad, what's the best time for me to begin saving $12,000 a year? Now or when I'm 49? What would you say? You say, honey, now, because you build compounding growth. I said, if you save at 49, you're never going to catch what you would have done if you'd done it at 29. Same thing with the reverse mortgage line of credit. If you start now, you get 9%. And someone says, well, Don, I could start later. If I'm older, I'll get more money. Yep. If my house is worth more, yep. And we've done the research to say, but the probability that you're going to catch starting this sooner than later is really negligible. Secondly, someone says, aren't interest rates high? I said, they're not high. They're higher. Some of you listening remember you got a mortgage at 11 or 12%, 14%. My first mortgage was at 9.5. I thought we stole money. We ran out of this and, let's get out of here fast before they catch us. Right now, when you get to 3 and 2 and 4%, we're spoiled. So interest rates are not high, they're higher. So what do? Don, that means there's less money available in the reverse mortgage line of credit. Possibly. I said, but it's not growing at 4% anymore. It's growing at 9%. I said, what was your house when COVID first began in March of 2020? Do you remember what your house value was? It's a lot more today for most people. It's a ton more. 3.5 years later at this recording, it's a ton more. So your $400,000 home is now $600,000. And I tell folks, you're probably getting the exact same amount you would have gotten for your home benefit amount at the beginning of COVID. What's the difference? One's growing at 4%. This one's growing at 9%. I'd rather have the 9% growth. I'm not yet 62. When my wife turns 62, we're doing a reverse mortgage. We're buying our next home, using it, and we're going to make voluntary payments. Why? Because I want my line of credit to be $2 million. I want it to be stupid big, and I'm taking advantage of it. This is not the 60-second commercial, folks. What Logan has us talking about here is this is the strategic planning for a reverse mortgage to incorporate with the retirement income plan. It's very powerful. Logan, I don't know if I can give a place where they can watch my master class, or you want to put it in the details. That's up to you.
I'll stick it in the YouTube. Yeah, I'll stick it in the description of the YouTube channel. And Don has a lot of content on the reverse mortgage. For what my opinion is worth, I consider Don Graves to be basically the nation's foremost expert on reverse mortgages. He's taught me a lot. I will never pretend to be an expert on reverse mortgages, but he's taught me enough to know that if I meet anyone who is eligible, they need to be aware of this, right? They need to know about this. And it's sad to me how many retired people and how many people in the financial industry are either not aware of this at all, or they don't bring it up because they don't think it's advantageous and they just haven't taken the time to understand it, right? One of the most important things I try to do when I'm working with clients is to take a big picture perspective. That doesn't mean I'm an expert in everything. It just means we need to take a big picture perspective, like Don has been doing here. He's not, he specializes in reverse mortgages, but he's situating it in your overall retirement plan. There are going to be multiple streams of income. There are going to be multiple things that we're hopefully going to have in place, all of which have a place in your retirement plan. Okay. And this is one of them. But I think it's one that a lot of people unfortunately ignore, because you probably have the statistics, Don, but when people retire, oftentimes their house and the equity they have in their house is where most of their money is. And why wouldn't you want to turn that into some kind of a source of income, or at least have access to it through a non-recourse loan, so you can access it without worrying about getting foreclosed on or something, right?
Or at least know what's in there. At least know.
Yeah, at least take the time to educate yourself. This to me is really the biggest thing with, I think, all financial tools and all financial planning. You need a client who's willing to take the time to educate themselves. And if they are, they're probably going to make the right decision at the end of the day. Whatever that decision is, they're probably going to have a good plan. Unfortunately, a lot of people just don't want to think. They don't want to read. They don't want to learn. And then it's limited, how much they can be helped, right? Because this does take some time. If you're going to do a reverse mortgage or any of the strategies that Don or I would recommend, you do need to invest some time and some energy in making sure that you understand what we're doing here. Because as other people have said, I can give you the best made tool in the world, but if you don't know how to use it, not only are you probably going to get no value from it, you're probably going to break it, not because there's anything wrong with the tool, but because we didn't take the time, you didn't take the time to make sure you understand how you're using it. Because a reverse mortgage also can be used in a lot of different ways. It can be a lot of different things to a lot of different people. That's part of what's so great about it, right?
Absolutely. Absolutely.
So Don, we're reaching the end of our allotted time, but do you want to just close us off with a few comments on why people should consider a reverse mortgage?
Reverse mortgages are not new. They're not dangerous. They're not spooky. They come under the watchful eye of the Federal Housing Administration of the United States government. They're secure and overseen as Social Security or Medicare. It's another qualified asset that you have. 87% of you own a home. You've got three buckets, primarily in retirement. Your income bucket, Social Security pension, maybe still employment, your investment bucket, IRA, 401k, 403bs, all of that in your insurance bucket, fixed and variable annuities, whole and term life insurance, disability, perhaps long-term care. Will those three buckets be enough to last you as long as you do maintain your purchasing power? I want to suggest that they're not going to be enough. 6 to 8% of the total wealth of today's baby boomers in their home. That's your fourth bucket. You've got a house. The house may or may not have a mortgage on it. What would retirement be like if you didn't have to make a monthly mortgage payment? What would retirement be like if you could turn your mandatory mortgage payment to a voluntary one? Would that help you to sleep better, spend less, save more, enjoy? Right. So where's my thing? Here, listen, folks. Everyone who has a home typically has this deal on the outside, a spigot, faucet if you're not from Kentucky. You have the opportunity. You have the opportunity to at least.
It's a thingamajig. It's a thingamajig.
That deal out there. You have the opportunity to at least say, well, I don't know what's in my other qualified plan, right? If you had some 401k that you forgot about and you get a letter and you find out it's legitimate and you say, hey, what do you want to do with this 401k you got over here? It got rolled over and you left the company 12 years ago. You forgot about it. Wouldn't you want to know? When your first question would be, well, how much is in there? You would want to know. Then you can make a decision. Oh, it's only $15. Give that somewhere. But if they said, no, it's $85,000. But you would want to know how much you had in your other qualified plan. That's what a reverse mortgage is. My advocacy is whether you deal with me or not, that's okay. And I can help you. And in 50 states, I've got a team of 200 people that I give leadership to, so we can help you. I think in the comments, there'll be a place for you to watch an educational presentation.
Yeah. We'll put that in there. And to close us off, I want to point out one other thing that I like, which is that as you're drawing down assets from, let's say, an investment account, the value of your investment goes down. So if you have $100,000 in an investment account, you draw down 20,000, you now only have 80,000 remaining, assuming you didn't pay any taxes on that. Okay. When you draw income from a reverse mortgage, the value of your house does not go down. It is not affected. It keeps going up. That's another thing that's really important to understand. I talk a lot about the infinite banking concept, which uses whole life insurance. And there's an analogy there because one of the beautiful things about cash value and a whole life insurance policy is when you access it via a policy loan, your cash value doesn't go down. It keeps going up. You're still earning interest and dividends. Same thing is true here. So that's important to understand. So however much money you have in your reverse mortgage, it's important to understand that you can access it in a way that does not reduce the value of your home. Okay, that's not true in other accounts. So you cannot compare, let's say, $100,000 in an investment account to $100,000 in a reverse mortgage because you can access it on more favorable terms. You don't have to liquidate the asset in order to get the money. So that's a whole other thing that, from my perspective, I like to talk about. But Don, we really appreciate you coming on and educating us about reverse mortgage. We will put into the description section of the YouTube video links to Don's material. He's got a lot of it. I encourage you all to do research on reverse mortgages. Tell your parents about it or your grandparents about it if you're not in a situation to take advantage of it of yourself. But I think this is a great tool that anyone who's planning retirement needs to be aware of. Okay. So thank you again, Don, for your time and insights. Greatly appreciate it. Thank you so much.
Thanks, Logan.